Welcome to the Jill on Money Show. It's Sunday, July 7th, and we are here trying to talk about the things that we think you might find interesting and also to answer your financial questions. If something's going on in your life, you need a little guidance, you need a second opinion, just go to our website, jillonmoney.com, click the Contact Us button, write us a note, and check the box if you'd like to join us on the air live. While you're on the website, you can sign up for the free weekly newsletter and do check out our YouTube show. It's called Jill on Money, powered by the Compound. And speaking of the Compound, we've got the third part of our interview with Barry Ritholtz today. I really became reacquainted with Barry through my collaboration on the Compound and Friends. Barry Ritholtz and Josh Brown, Josh, one of the hosts of the Compound and Friends, started Ritholtz Wealth Management more than a decade ago, and I've been watching them grow from afar, and now happily have a courtside seat to see everything going on at Ritholtz and the Compound. Anyway, today is the third part of our interview with Barry Ritholtz. You guys don't manage portfolios in a uniform way. In other words,
what do you mean? I think we do.
No, I'm just asking this question. I should. There's a question mark coming. But in other words, every advisor, how do they? What is their analysis? They say, do you have a conservative portfolio, a balanced portfolio? Like, how are you managing money?
First, we learn never to ask people, do you want an aggressive or conservative portfolio? Because the pushback you get has nothing to do with their risk tolerance or their goals. I'm not a conservative. I'm not aggressive. It's like, all right, so return is a function of how much risk you assume.
Right.
Right? And risk essentially means the range of possible outcomes up to and including your expected returns, but also the returns, that here's the dispersion. You may be minus 20%, you might be plus 20%. That's what risk is. You don't know what that outcome is going to be. It's a defined set of parameters. But we don't know exactly what it is. Here's the probabilities, here's the history. And if you, the longer the timeline, the narrower that dispersion of potential outcomes become. There's still risk involved. Otherwise, riskless, if you want riskless returns, you have to buy a U.S. Treasury. Right. That's it. So any return that's generated involves some form of risk. When we have advisors put together a financial plan, figure out people's financial goals, understand their ability to deal with market volatility, and we try and educate, hey, 1 out of every 4 years, you should expect the market to be down. That's what history says. And 1 out of every 10 years, you should expect it to be down substantially. Here's what it looks like 2 years, 5 years, 10 years, 20 years. So we create a series of different types of portfolios. Okay. The core portfolio is this much equity and this much bond.
And what do you use inside of those? Do you use ETFs? Do you use big futures positions? Do you have separately managed accounts? Like, how did they work?
On the 401k side, it's all mutual funds.
Yep.
On the non-401k side, the preference is for ETFs because of their inherent tax efficiency and a lack of phantom taxes. If we have people who are dealing with substantial capital gains, inherited stock, sale of a business, sometimes just sale of a house, or a startup company, we've been using custom indexing through Canvas, now part of Franklin Templeton, previously part of O'Shaughnessy, which is now part of Franklin Templeton. And that essentially uses the core portfolios, but instead of holding 10 ETFs, you'll hold 800 stocks, the average positions of those 10 ETFs, and that allows a whole lot more efficient tax loss harvesting to offset the capital gains.
What do you think people don't understand when they think about investment management? What do you think? You've been doing this now for 3 decades. What is the core principle that you think would, that you really want to tell people, like, here's what you don't get? And it can be the simplest thing, and it can be a sophisticated thing. What don't we get as individuals?
We only have 10 minutes left. This is a long conversation. All right. In bullet points.
Just do one first.
Well, the biggest, the easiest, the most obvious is the single biggest obstacle to your successful investing is your behavior. I mean, it's easy. Markets bottom when enough people panic, sell out. The statistics are 2 years after a capitulation, maybe it's 5 years, but it's some substantial period after a big market bottom, 30% of investors have not returned to equities. And from our experience, we had a ton of email. hey, when you said in January '08 you were 100% cash other than the short positions, which, by the way, we don't do here, but at the institutional firm we could. I followed you out on the market. I thought that was right. But in March '09, when you said cover your shorts and go long, I didn't believe you that NASDAQ down whatever it was, 75%, the S&P down 57% was a good entry. And in 2012, 13, 14, we were getting emails, even 2015. I followed you out of the market. I thought you were crazy when you went back in. I'm still sitting in cash.
Okay, so you are your own worst enemy.
100%.
Number 2.
So the second one is I wrote a column, I want to say it's 2015 or 16 for Bloomberg. I'm a big William Goldman fan. Someone had given me for my birthday Adventures in the Screen Trade. I read it a long time ago. And the quote that just leapt out of that book that I wrote a column on almost 10 years ago was nobody knows anything.
I love it.
And in the book he talks about Star Wars couldn't get made. All the studios passed on it. Raiders of the Lost Ark, no one wanted. No one wanted E.T. Like the list goes on and on. And the caveat quote to that is Paul Graham, who said, "Experts are experts in the way the world used to be." Trying to predict public taste for a film 5 years hence, from the time it's greenlighted to opening day, it's impossible. But the same thing is so true and is so humbling, and I think people don't realize how much humility is involved in being a good investor. You have to admit you don't know a whole lot more than you do know. You don't know when the Fed's going to cut. You don't know what non-farm payroll is going to be this weekend. You don't know where the market's going to be a year from now. You don't know who's going to win the AI race, just like you didn't know who was going to win the internet race, just like you didn't know who was going to win the computer race before that. It's incredibly humbling to say most of the things happening that are going to happen, we don't know, but we will humbly build a portfolio that's robust enough to withstand all of these outcomes, this range of outcomes. Right? Or more accurately, this range of outcomes. As opposed to making a bet on this, and you're either right or wrong. The people who do that successfully over time, and we know their names because they're so few and far between. There's a Michael Jordan and a LeBron James and a handful of other people. Maybe Caitlin Clark. The Warren Buffetts and the Peter Lynch's and the handful. Yep. But they're the exceptions that prove the rule. There are a few dozen, maybe 100 fund managers that have, like Peter Lynch, to his credit, after 13 years, he tapped out and said, "I'm done. I'm never going to be able to beat this." And I think everybody loves to listen to Peter Lynch and they love to pay attention to Warren Buffett. They ignore everything they say. They ignore how hard
I love when Warren Buffett had that one letter where he said, "I told my heirs to put 90% of their money in the S&P 500 index and 10% in T-bills." Yeah, that's what I told them to do. I mean, good enough for Warren Buffett's heirs, good enough for me. You're your own worst enemy. Nobody knows anything. What's number 3?
So let's go with Hemingway.
Okay.
Gradually, then suddenly. So
say more about that.
So in one of The Sun Also Rises, I think that's the book. Someone asked someone how they went bankrupt, and the answer is gradually and then suddenly, gradually then all at once. And I told the story about I'm not a Corvette guy, but the C2 Corvette from 1963 to 1967. Probably the most beautiful car America has ever produced. As nice as anything out of Europe, any of the German or the Italian cars. Spectacular. It's a work of art. It's a rolling sculpture. And a couple of years ago, I got to spend an afternoon in somebody else's. And you just forget. So first of all, it's not a 3-part harness. It's just a lap belt. Yeah. There is no passenger mirror. It's not that it fell off. They just didn't think it was important. The brakes are like you're stopping a 1940s truck. The steering is like, it's like you have to be Popeye to. And it's the only thing it had going for it, aside from its beauty, was this big, gorgeous 300 plus horsepower engine, or if you got the 427, it's a 400 horsepower engine in 1967. Just ridiculous. But it drives like a piece of crap. And then you get into a modern car, and I have a 3D camera showing me exactly where I am pulling into a stop. The car will automatically stop if I'm going to plow into someone in front of me. The steering is light. The seats are air conditioned. Like everything, you just don't realize the effects of gradual incremental change over time. In automobiles, it's safety, luxury, convenience, speed.
Yep.
In the market, it's the power of compounding.
Yep.
And how long money adds up onto money. It's gradually and then all at once. My favorite example of this, there are a bunch of like really idiotic memes. A lot of what I write is disproving really stupid nonsense on Twitter or TikTok or wherever. Your money is lost over the last century. Your money has lost 96% of its value.
Whatever.
Oh my God. What do you think? A dollar bill is a store of value for a century? Your money has to hold its value from the time you earn it till you spend it, invest it, or pay your taxes with it. It's a medium of exchange. It's not a long-term store of value. And my favorite example of gradually then suddenly is two guys go off to World War II. One takes $1,000, buries it in his backyard in a mason jar. The other guy puts it in the market. 100 years later, the family of the guy who buried it in the mason jar finds it. To be fair to that idiotic meme, those $1,000 have lost 96% of their purchase powers because the dollar was not designed to be buried in a backyard for 100 years. The guy who invested it in the stock market for a century, what do you think that $1,000 turned into?
Oh my God, hundreds and millions. And
when I tell people over $30 million,
it's amazing.
They don't believe me.
Thanks again to Barry Ritholtz for joining us for the long weekend. And if you've got a question, a concern, an issue, just go to JillOnMoney.com, click the Contact Us button. Let us know if you'd like to join us on the air live. While you're there, check out the blog and videos and resources. And don't forget to sign up for the free weekly newsletter. We love that newsletter. Every Friday, Mark does a great job with that. You can subscribe to us on the Odyssey app or wherever you find your favorite podcasts. Don't forget to put your hands metaphorically or even physically on someone's back. Someone needs a little boost. Change your work, change your wealth, change your life. Thank you for listening, and we'll talk to you tomorrow.